I guess what we can do, Brian, is I'll go ahead and give you an intro, and
Sure.
then if we see a couple more people queue up in a little bit, maybe like 5 minutes, just kind of quickly reintroduce yourself,
Sure.
that people know who you are.
Very good.
All right. Thanks everybody for jumping on to tonight's webinar or this evening's webinar, depending on where exactly you live. This is one of our client-only webinars, so you're only here if you're a client of Paul CPA or if you're a client of Brian's. So tonight we have Brian Eastman. He's going to be a guest speaker for us. He works at Safeguard Advisors, and he is basically an expert in self-directed IRAs and 401ks, solo 401ks, all things retirement accounts. He has a wealth of experience as an entrepreneur and a real estate investor, so it should be a fun talk tonight. Now, our firm refers clients to Brian whenever our clients have like a question about self-directed IRAs or solo 401ks. So if you have come to me in the past and you've said, hey, I want to open up a solo 401k for my business, I'm probably saying, go talk to Brian. He's gonna handle it from here. So he's been great for us. Awesome client experience. We've gotten a lot of great feedback, and that's mainly the big reason I wanted Brian to come on and give a presentation for our clients here. So I think Brian can explain pretty complex topics in a very simple way. He articulates himself very well. So it should be a good presentation tonight. Now, before we begin, just two quick reminders. One, we did disable the chat. So hopefully you can't chat with anybody. And then the other thing is find the Q&A button. I think on your screen, it's at the bottom of the screen. And that's how we want you to be asking questions tonight. So if you have any questions, feel free to click that Q&A button, type in your question, and send it over to Brian. Just remember, if you don't check the box to ask anonymously, everybody in the room here is going to be able to see that you asked the question. So just kind of keep that in mind too. With that, I'm going to let Brian take over, and I'm going to turn my video off, so it'll just be Brian, and I'll be in the background kind of answering some questions and making sure everything runs smoothly. All right, Brian.
Excellent. Well, hey, thanks a lot, Brandon. Nice to be on board and get to share a little bit of information about some self-directed retirement plans. And of course, the main thing I'm excited about today is thanks to the 2017 Tax Cuts and Jobs Act, there's some new approaches in working with various types of investments one might do in a self-directed IRA. So we're going to focus on that. Seems like we have 9 folks, and that's what's been here from the beginning. So let's go ahead and get started. The focus today is talking about a narrow band of exposure within IRA and 401k plans to what's called UBIT, or unrelated business income tax. And we're going to talk a little bit about what that is, when it applies, and some strategies for either avoiding or at least mitigating the impacts so that we can ensure the profitability of the investments that our clients are doing with their self-directed plan. So with that, I'm going to go ahead and after sharing my smiling face with you guys, I'm going to switch and go into presentation mode here, and we'll get into the topic and look forward to answering some questions as we get to the end. All right, so you should be able to see the presentation now. And again, like I said, we're going to talk today about understanding and mitigating UBIT in a self-directed retirement plan. Start with, hang on, let me get on the right screen. Okay. Start with just a very little bit about myself and my company. I'm a principal at Safeguard Advisors. We're a leading provider of self-directed retirement plans that offer what we call checkbook control. So you can pretty much invest in anything the IRS rules allow for, and you don't have to go through third-party intermediaries for a lot of different types of investments. It's the right way to go. We've been in business since 2005, working with thousands of clients all across the country. We really focus not just on the creation of a plan that puts our clients in control of the funds, but also ongoing consulting to help folks know what they can and can't do, and how to go about pursuing certain issues. And of course, a big part of what we do is we partner with professionals like Brandon, who bring a whole other realm of tax experience and become part of an overall investment team for our clients. But the thing we bring is we've just got a lot of real estate experience and tax law experience in-house. Of course, all our plans are authored and supported by a very skilled tax attorney who's been doing this stuff for, oh gosh, a couple decades now. So that's a little bit about us and why we're here to speak on this topic. The other just sort of high level introductory thing for those of you who may or may not know, what is a self-directed IRA? And the real simple answer is an IRA is an IRA is an IRA. Same with the 401k. We configure a different version of those plans that is able to invest more flexibly. But if it's an IRA, a simple IRA, SEP IRA, Roth IRA, all flavors are available. We also work with the individual 401k format for people who are self-employed and don't have any full-time employees. We just configure the plans differently so that they have broader investment choices beyond just what the stock market firms sell. And for the most part, clients are using our plans to invest in things like rental property, maybe other types of real estate related transactions like new construction or flipping of houses, private lending like mortgages and trust deeds or other types of microloans, various forms of real estate partnerships, buying into a syndicate of investors, eight investors going to buy an apartment complex together, stuff like that. But there's a whole lot. I mean, there's private placements and cryptocurrency and a huge amount of things that people can invest in with these plans, and we'll help people to do that. So that's kind of the background from which we're starting is, okay, when you're using one of these plans, what are some of the things you need to know? The main focus of our conversation today is something that sneaks up on a lot of people as they start researching self-directed plans, and it's a concept called UBIT. Well, typical to IRS alphabet soup, it's one of those terms that gets thrown around. What UBIT stands for is Unrelated Business Income Tax, or UBIT. Can often get real confusing if you're talking to folks who are looking on the websites, because you'll also see UBTI, which stands for Unrelated Business Taxable Income, or UDFI, which is a subset of UBIT that applies when debt financing is used. But the basic core principle of unrelated business income tax is what we're going to talk about today. And what UBIT is it's something that applies to all tax-exempt entities, pre-existed retirement plans by about 30 years, actually. And it's a tax designed to level the playing field when you have tax-exempt entities competing with tax-paying businesses. So the requirement there is that if you have a tax exempt engaging in a trade or a business activity on a regular or repeated basis, and therefore substantially competing with tax-paying businesses, well, Congress figured out a long time ago, well, that's not going to serve the public good. So this tax was implemented to level that playing field and protect those tax-paying businesses from unfair competition. The rate that applies to retirement plans or trust tax rates, they're on a graduated scale, but they pretty quickly get to the maximum trust tax rate of 39.6% federal. In some cases, you'll have a state component, a parallel tax, usually not nearly that high, but something in the 6 to 10% range, perhaps, in addition to the federal. So it's a pretty strong disincentive for tax-exempt entities to act like a business and compete with tax-paying businesses. So the big question then is, okay, well, what creates exposure to you, but what activities are subject to this taxation? And the first thing to start out with is that most things that most people are doing with a self-directed retirement plan don't have this exposure. Things that are passive in nature are exempted, and passive income is things like interest, dividends, royalties, rent from real property, or the future sale of an asset that's been held over time to produce passive income. So a lot of folks who are investing in direct ownership of rental properties, or maybe a syndicated deal that's running an apartment complex, or they're doing private lending, things like that. Those are all passive forms of income and don't even need to worry about exposure to UBIT. Where we get into UBIT is more business type active ventures, and in the real estate space, that's typically things like flipping or wholesaling, new property spec home development, things along those lines. There are certain types of real estate funds or crowd funds that people might be attracted to, where the underlying activity of that fund is a business activity. If you were investing in a fund that was holding a portfolio of rental properties, there'd be no UBIT. But if you're investing in a fund that's actually going out and flipping a bunch of houses, well, that's a business and something that would have this UBIT tax component. And another place, and something we have a lot of clients doing sort of outside of real estate, is various forms of venture capital and private placements. And we'll talk a little bit about where UBIT might apply in those types of sort of business equity investments, and what the impact will be there. We'll cover that a little bit later as well. But that's the basic introduction to the concept of UBIT and when it applies. Let's take an example in the most common area that we see UBIT, which is people who want to flip properties. And again, the threshold for exposure to UBIT is engaging in a trade or business on a regular or repeated basis. So if you set up a self-directed retirement plan and only do one flip and then do a bunch of private lending and rentals, well, you've only done that once. You haven't met that regular or repeated test. But if you have a strategy that involves multiple flipping transactions, and we don't have a bright line of what crosses that threshold, but I'd say more than one or two a year, or even one a year every year for multiple years could be viewed as regular or repeated. So if you're going to be repeatedly engaging in flipping, you're going to have the UBIT exposure. Sometimes that may not be a deal killer. And we'll sort of run some numbers here to show you what that means. Here's a real super simple low-end example that I provided. So let's say you bought a property at auction with your IRA for $50,000. You rehabbed that property and turned around and sold it and had a net sales price of $100,000. And if we break that down, let's say there were, in addition to the purchase of $50,000, $25,000 of total cost, 19 of which was rehab on the property, and then another 6 that's going to get eaten up in sales commission and title fees and things like that. So that would leave you a nice round number of $25,000 of net income from that transaction. And that's what's going to be subject to the tax. It's not direct route. Your net profit is how you get there. You take your gross profit and you deduct out your expenses and whatever. But for ballpark considerations, you got your 25K of net income here. When you run that through the trust tax tables, you're going to end up with a tax amount due of a little more than $8,250. And that's not going to quite all be at the 39.6% rate. I think if you look at that example, it's probably about a 33% effective tax rate, because some of that was income below the 39.6 threshold and some of that was over. But at the end of the day, that wasn't a bad deal. You still had a $16,700 return on investment from the total of $69,000 of cash outlay between the purchase and the rehab, and that represents 24% return. Well, hey, I'm not getting 24% return on a rental property or my stock portfolio or things like that. So I might say, well, I understand flipping. There's opportunities in my market to flip. I'm going to go ahead and flip, and I'm going to pay the UBIT. And while it might not be the most theoretically tax efficient way to do flips, this is the capital I have, and that's the best return on investment that I'm going to get for my individual retirement plan. So I have a lot of clients who in the past have just chosen to go that route, which is flip, pay the taxes, and smile with a really nice return on investment. Of course, that takes good deals. If the deals are a lot skinnier, the UBIT's going to diminish the appeal of that strategy. Another approach that investors will often take is eliminating exposure to UBIT, and that's sort of the first alternative that I want to talk about here today in this discussion. And there's a couple different ways that you could go about, something like flip opportunities. Of course, you could translate this into, spec home development or other UBIT exposed areas as well. The first option, as I just mentioned, is, well, go ahead and flip, pay the UBIT, and if the numbers are still good, the numbers are still good. Just look at it as, hey, this is the way that I know I can get the best return for my IRA or 401k plan. There's two other alternatives that would eliminate the exposure to UBIT, and one is, instead of having your IRA be the flipper, have your IRA be the bank and lend money to another investor who's out flipping that house. And that works well for a lot of reasons. I mean, IRS rules prohibit you being dramatically involved in what's going on. You really need to think of yourself as a fund manager. So executing a flip with your IRA can be a little bit difficult to do hands-off anyway. I mean, you're always working with outside third-party contractors and project managers and things like that to begin with. So just taking one step further back and being the bank, lending money to somebody who's an investor out working in the flip space is a good way to create passive interest income that's not subject to UBIT. And, very typically you can lend money in the range of 2 to 3 points and 12 to 15% interest, depending on how well you know that person and what the numbers are and the risk factors and things like that. But that's pretty typical terms that you'll see for short-term rehab lending. Another option that we really like, and something we've heavily promoted for many years, is what we've sort of coined as a hybrid flip. Of course, the Thing with a flip opportunity is you're buying a property at a discount, either because it's in bad shape financially, or the physical plant facilities of the property are in bad shape, and there's an opportunity to add value either by solving financing or the condition of the property or both. Well, if you buy a property at a discount, you add value and you turn around and resell that property and capture that value immediately. That's a dealer type transaction. There's no passive component to that, so it's going to have the UBIT exposure. However, you can recharacterize the transaction and make it passive by acquiring the property, holding it and operating it as a passive rental for at least a year, and then selling it. And now when you go to sell, well, that's not a dealer transaction. You're now disposing of what's been a passive investment asset, so there's no tax implications of that sale, and you get, positive cash flow, hopefully, from that period of rental, whether it's a year or 2 years or three, it doesn't matter as long as it's at least a year. And then also the appreciation on the property and the value that you've added through the rehab, you'll capture without diminishing that via taxes. So that's a real popular strategy. It doesn't work in all markets. In some markets, you just got to turn them, or some people just have no interest in being a landlord or owning rental property. So not for everybody, but it's a strategy that works really well. So those are sort of three different ways to look at something like flip opportunities in the IRA space and navigate around UBIT. Another place where UBIT can apply is in the areas of various types of funds and private placements and venture capital, basically where you're investing in the equity participation in somebody else's business is a simple way to describe that variety of activities. And that works well, and a lot of funds or private placements won't have exposure to UBIT, but there's just a couple of questions that you want to be asking if you're going to be participating in these types of opportunities. Of course, if you're a client of ours and you have an opportunity, you chat with us, we'll help you sort these things out. But the first is just making sure whether there's going to be UBIT exposure in the first place. Part of it, the primary driver, is what's the nature of the activity. As I mentioned earlier, if you were investing in a fund that was going to be doing a tranche of notes, for example, and really receiving interest income or holding rental properties or things along those lines, well, then that's passive activity that the fund is engaging in, and it's not going to pass through tax liability to an IRA investor. But if the activities of that fund or company or whatever are something like new property development or property rehab, something that is a trader business, then you're going to have the UBIT exposure is going to flow through that entity to you, depending on the next question, which is what's the structure of the entity being invested in. Of course, if you're investing in something that's a subchapter C corporation, a taxable corporation, that corporation goes out and does whatever it does, passive, active, otherwise, it's going to pay corporate taxes before issuing dividends to the shareholders. Well, as an investor, you'd be a shareholder, you'd be getting passive dividend income. So if it's a C corporation, it doesn't matter what the underlying activities are as far as tax exposure. UBIT's not going to apply. The taxes have already been paid. But if the entity is structured in some form of a pass-through, like a limited partnership or an LLC or things along those lines, those types of entities pass their tax liability through to the owners. And if your IRA or 401k is a member in some kind of a partnership, it's going to have the tax exposure based on whatever the underlying. So the first question is what kind of activity and what kind of entity will help determine whether UBIT's going to apply. Another place where UBIT can apply, but may or may not be a big issue, is in what we would call a true venture capital play. And that's where you're participating in some kind of a startup and you're providing capital to a business. Well, okay, that business might be, totally unrelated to real estate. It might be a software company, for example, and you're putting capital into that business. That business is going to go out and it's going to operate, and it may generate operating income. And if it's not a C corporation, the taxes are going to flow through as UBIT to an investor. But in that case, that operating income, especially in the startup mode, that's typically not the prize that you're after. But that's what's taxed. And in some cases, you might even have losses in your first couple of years, and then, those losses will offset operating income gains in future years. But the prize of a true venture capital play is the gain in value. You bought in at $100 a share. If the company goes to second level funding or goes public or whatever, you're going to be able to sell out at $300,000, $500,000 a share, whatever. Well, that gain in share value is not subject to UBIT. So even though there may be UBIT exposure in a limited fashion in a venture capital opportunity, it doesn't necessarily mean it's a reason to avoid that. So there's a couple thoughts around that there. This last piece here is the kind of exciting part of our conversation today, and this is new. Well, not exactly new, but new thanks to the tax law changes, the 2017 Tax Cuts and Jobs Act, because effectively one of the key aspects of the new tax law is reducing the federal corporate tax rate to 21% from a graduated scale where the top rate was about 35% in the past. That allows us to take advantage of what's called a UBIT blocker. And what a UBIT blocker is it's taking the UBIT exposed activity and operating that activity within a taxable C corporation. And it could be done with a true corporation. It could be done with an LLC that elects C corporation status, which is typically the route we're going to go. But basically, you take that UBIT exposed activity and you put it in a corporate wrapper. You have that corporate entity engage in the activity and pay its corporate taxes. But then the after corporate tax profits are going to be issued as tax exempted dividends back to the retirement plan. So it doesn't eliminate exposure, but it dramatically reduces the exposure from, potentially as high as 39.6% at the maximum trust rates down to that 21% flat corporate rate that's the new corporate rate. So that can be a real big advantage. In fact, I'm going to go back. I didn't get this into my presentation, but I'm going to go back to my example. And if we go to this property flip, if you take this and you insert a blocker corporation and assume the same numbers, so your $50,000 acquisition cost, your $19,000 of rehab, your sales commission, you still have your same $25,000 in net income. Well, if you take that $25,000 in net income and multiply it times 21%, now you're looking at a tax amount of just over $5,200. So about a $3,000 reduction in the taxable amount. Your net return as a result ends up being about $19,750. So it increased there. That $3,000 goes from the tax side of the equation to the net return side of the equation, and your effective ROI on your initial investment bumps up to more like 28%. Well, you start taking the same example and multiplying it times 3 or 4 times a year. Firstly, in the UBIT exposure, your rate's going to go up. It's not going to be a 32% tax. It's going to probably get a lot closer to that 39%, but it would stay a flat 21% in the UBIT blocker. So it could be a pretty dramatic increase in the profitability of those deals. And again, it doesn't totally eliminate the UBIT, but it mitigates it to the point where it might make it a lot more attractive for a lot more people to go about flipping. So that is kind of the extent of things, and we're going to go ahead and see if I can figure out how to get the screen back to video mode, and now we can go ahead and open up our Q&A. Have a question here from Mary. Mentioned that she has a self-directed 401k and asked if we could point out any differences as we go, and there really aren't. IRAs and 401ks both have the exact same exposure to UBIT taxation. There is a difference between the plans when it comes to a subset that we haven't talked about today that it relates with debt financing. But for everything we've talked about today, a 401k and an IRA are treated the same. Have another question from Chris asking about UDFI as particular concerns, and asked if we could touch on that. I'll defer to Brandon if we want to tangent out and go to that. I mean, we might cover that in another topic another time, but very high level, that applies when debt financing is used, a different topic than what we're talking about today.
Yeah, UDFI is a little bit of a different topic, but is somewhat in there with UBIT as well. So UDFI applies when you have financing on a real estate asset, or I guess any asset. And what they do is, I guess a super easy example would say, let's say that your asset's worth $10,000 and you have $7,000 worth of financing. The income that's coming in, 70% of that would be subject to UDFI. And the reason that UDFI is in place is so that the basically, again, going back to like what Brian was saying at the very beginning, where he was saying, these laws were in place to kind of ensure that people in retirement accounts weren't like realizing any massive benefits. And it's the same thing there. It's like, well, we don't want you to use your retirement account to go and finance a bunch of assets and finance a business and everything like that. So that's why they have that UDFI in place.
Yeah, I wouldn't even necessarily go so far as to say it's a disincentive. The idea when you're leveraging is you're accelerating the growth of your retirement plan by bringing non-retirement money into the picture. And UDFI represents just a small cost for being able to bring that money in. You'll still get the benefits of leverage. You'll still get a higher cash on cash return. It's just, again, there's a cost for bringing non-IRA money into the IRA picture. And that's where, going back to Mary's original question, there is a difference between IRAs and 401ks. IRAs are broadly subject to UDFI on any leveraged investment. 401ks subject to UDFI on anything except for debt instruments that are secured by real estate. So that's most of what people are doing. But if you were to, trade stocks on margin or be involved in some partnership that was doing leveraged buyouts or things like that, you could still have UDFI exposure in a 401k there.
So I've got a question for you, Brian.
Sure.
We get this question. We get a lot of questions about UBIT and really just about how can I use my self-directed funds or my solo 401k funds. And maybe you can't advise on this in particular, so just let me know if that's the case. But
sure.
If I'm a client and I'm trying to figure out how to best utilize my 401k or my self-directed IRA, are there particular types of investments, maybe like equity versus debt, that make more sense?
It can. We don't get in the business of recommending one investment or another or looking at a particular investment. What we want to do is give clients control over their funds and then some guidance as they look at the opportunities before them. So it's usually somebody comes to us and says, well, I'm going to do X or Y, or I'm looking at X, and I might say, well, here's the issues. Do you maybe want to consider Y? Something like that. There's no hard and fast rule. There's a variety of investments out there that are going to have different profiles as far as risk and return. They may or may not have exposure to some of these specialty taxes like UBIT and UDFI, but you got to evaluate the opportunity and look at the numbers, and that's ultimately what it boils down to. Certainly for a lot of people, if you've got two opportunities that are relatively the same in their overall return, the one that's going to not be subject to UBIT is going to be favorable because it eliminates the need to deal with that extra administrative layer and the tax cost and things like that.
And Marianne, I know you asked something, but I'm going to jump in. So we also get a lot of questions around like, all right, well, how can I invest in a syndication? Like, the guys that are raising $3 million to go buy a 200-unit apartment complex.
Mm-hmm.
And I'm not going to ask about like the tax implications there, but what are some things that people should know or be aware of when they're going to use their retirement accounts to invest in syndications, or maybe
Sure.
even like lend money to another party?
Sure. Well, there's two different theories, but we have a lot of people wanting to do syndicates, whether it's 3 investors buying a $400,000 apartment, or 10 investors or 20 investors or 50 investors coming together on some multi-million-dollar deal. And it's sort of what I alluded to back in that slide about private placements. You want to understand what the nature of the transaction is. Is it going to be something that's going to create UBIT exposure? The other question would be, is it going to be using debt financing? Would that create UDFI? Because that would pass through from most entities like that. Most of those types of syndicates are LLCs or LLPs, and you have a general partner putting it together and then investor participants. But an IRA or 401k can be one of those investor participants. Obviously, one of the first concerns, and something sort of outside what we're talking about today, is making sure you're not dealing with any disqualified parties, like close family members who are the general partner. If you're the GP, you can't use your IRA to be an LP in your own deal, things like that. But it comes down to what's the nature of the activity. Is it going to create tax exposure? And if so, what are the impacts? Again, sometimes there can be exposure, but it's because of the strategy and how the exit strategies are laid out. It may or may not be detrimental to the return on investment. So again, it all becomes kind of individualized. There's some general guidelines and some questions you ask, and there's stuff we deal with it on our website and in conversations with clients who are interested in doing that kind of stuff.
Interesting. I think Mary's got a question.
Yeah, let's switch back over to that. So Mary asked if does an LLC electing to be taxed as a C corp provide the same help on UBIT blocker, and absolutely, and that's typically the strategy. I mean, we're working with a lot of clients implementing UBIT blockers. If we were setting up what's called a checkbook IRA, which is an IRA owned LLC, normally we have the LLC be a disregarded entity, so its tax liability flows through to the IRA. If you were going to be using such a vehicle exclusively for a UBIT exposed activity, we could make that IRA owned LLC the corporate election, and that would serve as a UBIT blocker. Of course, everything it does would then have the 21% tax rate. More commonly, we're seeing people who have a diversified portfolio and some assets that have UBIT exposure and some that don't. So they'll actually create a sub layer under the vehicle, the plan vehicle, to isolate the UBIT exposed activity. And that would be the case in Mary's case, where you've got a 401k. Well, the 401k can't adopt C Corp. It can't make that election. So what you would do is you'd have your larger 401k. You'd, within that 401k, form an LLC and have that LLC elect C Corp taxation. And then, that LLC will have to file tax returns at the state and federal level and deal with the taxation level, but then it would issue dividends of any leftover income back to the 401k, and those dividends would be tax deferred. So yeah, that's the strategy that you typically layer in to what you're doing.
All right, one more question for you, Brian. So, sorry, I keep making up all these questions. we get all these questions all the time. So
sure, good opportunity.
Yeah, asking some of the questions that I've been asked recently. Is there, in looking at the 401k versus the IRA, solo 401k versus self-directed IRA,
mm-hmm.
Is there one that you would recommend in certain circumstances, or maybe you just like one more than the other in almost all circumstances? Can you talk a little bit about that?
It's really going to depend on the investor. I mean, if you just looking in a vacuum at the two plans, the solo 401k is nicer. It's a more direct route to checkbook control. It's a little more cost effective. It's a more powerful retirement plan with higher contributions, and in debt finance situations, it eliminates UDFI. But the key difference is that you have to qualify for a 401k. You have to have a qualifying self-employment scenario where there's no full-time employees. So I talk to a lot of folks who maybe have that, maybe don't, maybe have that self-employment, but they know it's going to have an end game in 2-3 years down the road. And once the business goes away, the 401k goes away. You have to roll it out to an IRA at that point anyway. You can't just keep rolling forward. So there's times where we'll look at qualification. There's other people who might qualify for a 401k on a borderline basis, but they're not going to take advantage of any of the incremental benefits that the 401k provides. And in that case, there's a little bit of additional simplicity and a certain permanency that the IRA creates. So that might be a better choice in those scenarios. It really is, again, the 401k is better, but not for everybody. I would say in general, probably about 35% of the people we work with end up in the 401k, but the large majority end up in an IRA.
Excellent. Well, we've got one more question from Mary, and then I think after that, we will wrap it up.
Sounds good. So Mary has asked, does it make sense to partner with another flipper and loan each other money, and are there risks to this strategy? And the answer is there could be. You always want to be careful not to be setting up any kind of quid pro quo arrangement and making it look like you're going through some other unrelated third party, but in effect doing something circular so that your plan money is in effect coming back to you. So that would be the concern with a transaction such as what you might be indicating there, and we would typically recommend against that.
Awesome. Brian, thank you so much for jumping on. I think that everybody here has learned something new. I definitely have. The
cool.
UBIT blocker strategy, that's awesome.
Yeah, we're expecting that with this. I mean, the strategy's been around forever, but
yeah,
it really didn't make sense unless you were working with millions of dollars and doing weird stuff having to do with offshore entities. And just for your average investor, it didn't make sense. So it's not a new strategy, but with the tax code changes, it becomes something that'll be newly effective for a lot of people. And we expect that a lot of people are going to be moving in that direction, either with a plan that they already have and layering in, an additional structure on top of it, or as new people are coming into the pipeline and setting up new plans, it might be it'll be an optional, it'll be a switch. Hey, do I want to have this additional feature in the plan? And it'll just depend on what somebody's strategy is. It's gonna be
Awesome.
pretty cool.
Brian, where can people find you and connect with you?
We have our website is ira123.com. On the website, there's contact form, phone number. We have mechanisms you can use to just pick up phone and call or schedule an appointment. But it just all starts at ira123.com.
That's great. Well, thank you everybody for attending. Thank you, Brian, for presenting. We will be sending out a replay either tomorrow or the next day. So just keep your eye on the newsletter for that. And the presentation, if you want the PDF, I have uploaded that to share file in the public documents folder. So you guys all have access to that, and you can reference that in the future if you need to. Thanks a ton, everybody, for attending. Brian, thanks for the presentation. Really enjoyed it, and I hope everybody has a good rest of your evening.
Great. Thanks for having us.